On September 17th, the FOMC will decide whether they're going to cut interest rates. This choice benefits a select few individuals and leaves the rest of us on the other side holding dollars that are losing purchasing power at a very rapid rate. In this video, we'll check out the data that supports why the Fed has to be comfortable with 3+% inflation, what that means for the average American consumer, what that means for the average Canadian consumer, and how you as an individual can protect and grow your purchasing power without worrying about US federal policy. So we have the date, September 17th. That is the day when too late Jerome Powell will decide the fate of the US financial economy over the next 2 years. Now, if you've been tuning into the news, especially this week, you've probably noticed there was a major headline that came out right before this upcoming FOMC meeting. And that headline was that CPI inflation had just ticked up to a critical level, right around 3%. So off the rip here, we have the US dollar index, the DXY. And over the last year, it's been dumping. Crazy amount. I believe this in the first half of the year, it dumped about 11%, one of the biggest drops in history. What you guys need to understand is a weaker dollar means a few things. Yes, it is beneficial for global liquidity. It means more countries have an easier time to trade in dollars. It's great for US exports. However, with a weaker dollar comes inflationary regimes, comes negative real rate regimes, and comes people and sovereigns and nation states flocking out of US treasuries to find yield, safe yield, guaranteed actual yield in other financial instruments like equities, like gold, and now like crypto. So you may be thinking, okay, weaker dollar means inflation. Why would a world leader want that? Well, in the case of the US, they have $37 trillion of debt. They have $10 trillion to roll this year alone. Inflation and currency debasement erode the real value of that debt over time. And in inflationary environments, things like equities, businesses tend to do really well because investors take their cash out of treasuries and are forced down the risk curve to find real yield, which segues perfectly into this tweet I pulled off of Twitter recently. It's this news channel quoting Donald Trump saying he's defending a weaker dollar. Now, if you've been watching the news, obviously, yes, Trump has been very vocal about wanting a weaker dollar. And here he's saying it will make us more money, it will make us richer. Then this account goes on to say that purchasing power will be lost from that currency when the dollar is weaker. Both of them are correct. Now you're probably wondering, how is that possible? Well, back to what I had just said previously. As purchasing power escapes from the dollar, investors will take that dollar that is losing value and put it somewhere where value is gained, as in equities, commodities like gold, and cryptocurrencies like Bitcoin. So then who's the one that's actually making the money? Well, it's business owners, the Mag 7, and then people who own assets, which last time I checked, isn't a lot of people in the middle class. So when Donald Trump says, we'll make more money, he's really referring to him and his buddies down at Liberty Capital. Here we have the US CPI with a 200-day moving average slapped onto it. And what I need you guys to understand is that 3% inflation will be the new normal under this Trump administration and potentially into the new administration 2 years down the line. Back to the debt burden. Higher inflation erodes the value, the real value of that $37 trillion they need to pay back. While at the same time has a juicing effect on the economy. So while their debt is being devalued, the economy has a chance to grow because monetary policy will no longer be so strict, so liquidity can flow through the economy more freely. Businesses can make more money. The US can export more goods. Equities will soar. And all of this is a product of an inflationary regime. Let's circle back to that point of rolling $10 trillion this year and how this ties into the oncoming rate cuts that we're going to see out of the US over the next 6 months. And the long story short is, imagine refinancing a credit card at twice the interest you had originally gotten it for. That's not super friendly, right? Imagine refinancing a mortgage at twice the mortgage rate you originally had. This is the situation the US finds themselves in right now, except with $10 trillion and rates are at 4.5% right now. So the US needs to get rates down. Interest rates and interest expenses are becoming the biggest liability to this US government. One of the mechanisms the US Treasury specifically can go about suppressing long end yields in the bond market is by buying back its own debt, which we've seen them begin to do quite extensively. And here we have a Twitter post saying the US Treasury has purchased $138 billion of its own bonds, far exceeding last year's $79 billion repurchasing. And down below says the Treasury's goal is to promote liquidity and cash management. Two things that come out of this. One, you suppress yields on the long end of the curve. Right here, here's the US 10-year slumping hard. Yields are falling. Treasuries are being bought back. Liquidity is being injected into the system. CPI is at 3% and not going down. And yet the Fed will still cut rates. Here's a quick clip from a previous report my fund published a while back, I believe it was sometime in August, where we highlighted that higher inflation is crucial to elongating liquidity cycles in the markets. Quick background. In order to refinance all of this debt, liquidity must be abundant in the system. And these refinancing periods happen roughly every 4 to 5 years. So every 4 to 5 years, markets are hit with big waves of liquidity in order for this government to refinance this debt. Now, when that can't be done in a substantial time manner, liquidity must be continually injected in order for the cycle to propagate longer so the government can roll its debt. And we highlighted this in a report back in August where we discussed the extension of this year's liquidity cycle. So guys, go do yourself a favor, buy some Bitcoin, preserve your purchasing power, and buckle in because we're about to see consistent 3% inflation, interest rates coming down to 2% in the US, and record high equity, gold, and Bitcoin numbers into the future. Now, if you guys like this video, make sure to hit that thumbs up, drop a comment down below, make sure to hit that subscribe button. I appreciate all the support, As always, I'm trying to build this channel up to help educate you and me on finance, spread the message, and I'll catch you guys in the next video.